Hi everyone, it's Anand here from Finance Fix. Right, the markets are down. I get it. I'm here to talk to you about what you should, and more importantly, what you shouldn't be doing in these market conditions. Since their highest point year, the markets are down. The S&P 500, which tracks the 500 largest stocks in the US, is down 20%. It has been down 34% since its peak this year. The FTSE 100, which tracks the top 100 companies in the United Kingdom, is down 26%. That was down 35% earlier this year. The MSCI Emerging Markets Index from Morgan Stanley, which tracks 800 securities across 26 emerging market economies, that is down 24%. That was also down 35% from its peak earlier this year. And I'm not talking about a whole year effect. We're only in April. We're only 4 months into the year. So the markets have been down significantly. Yes, they have rallied a lot since, but they're still on average 20 to 25% off their peaks. If you've got any kind of investment in a fund, an individual stock, an ETF, an index, whatever it is, you're seeing red right across your portfolio. So where does this all leave you? You are probably being ruled by the fear center of your brain at the moment, a region of your brain called the amygdala. This wants nothing but getting out of a state of fear. Nothing but. It doesn't care about your investments. It doesn't care how much value you might lose. It doesn't care whether it might be a bad idea. It just wants you to get out and stop being fearful of the market. You know that feeling you have that at the moment about wanting to put your head under a pillow and not worry about the position of your portfolio? That is the exact thing the amygdala is there to resolve. But regardless of how you're feeling at the moment, I'm here to tell you this is the worst time to sell, period. Unless you own stocks in companies that you have little to no confidence in, and here I'm saying you have no confidence in the businesses themselves, if that's the case, why the hell did you invest in these companies in the first place? I'd like to invite the logical side of your brain back into this process. Look, to investments, everyone has two modes, greed and fear. Remember the fear side of your brain I talked about earlier, the amygdala? All it wants you to do is allay your fears. Put those fears to bed and get out of whatever situation got you into that fear mode in the first place. In this case, it's the falling markets we see all around us. Fear doesn't care that you'll make those losses real. Fear doesn't care that this is the worst time to sell off parts of your investment portfolio that you've worked hard for years to build. Fear doesn't care about any of that. All it wants you to do is get out of this state of fear and get you back to your happy place. I just said something about making your losses real. And that's an important point because no matter what you're feeling, no matter what you're seeing on your investment portfolio screen at the moment, your losses are not real until you actually sell. With the moment you sell, that's when your losses become real. That's when you crystallize them. That's when you really lost that investment value. And that's when there's no turning back. All of that red you're seeing on your portfolio screen at the moment, those are just numbers on a screen. It's a paper loss. It affects your life in no way whatsoever. I'll repeat what I said earlier. The moment you sell is when you actually incur that loss. Until then, it's just numbers on a screen. Did you get that? Just numbers on a screen. So firstly, just breathe. Breathe. Now that you understand that your losses are just paper losses for the moment, just breathe and consider your investments. If you own stocks in individual companies, are those companies still solid businesses? Are the reasons you bought them and invested in those firms still valid from January to today? Forget the losses that they've incurred to date. Forget the stock market crash. Forget all of that. Were the reasons why you're invested in these firms, and the same goes for index funds or actively managed funds or ETFs, if the reasons for your investments were valid, say in January of this year, they're probably still valid today. If the fundamentals behind what you're invested in hasn't changed, then I wouldn't sell, period. No selling. I'd stay the course. I'd wait for the markets to turn, wait for sentiment to turn, wait for demand to return to the economy and the markets. Yes, people are saying all over screens and on blogs and in newspapers that demand will be subdued for some time. But if you're like me, I invest consistently. I invest for the long term. I'm not that interested in the short-term fluctuations of the market, whether it be now or in a normal trading scenario. I'm not a trader. I'm not trading on these stocks. I'm investing for the long term, for my financial security in years to come. You should really, if you be doing the exact opposite. Now is the time to top up, to buy in at these much lower levels. Could the market fall further? Of course it can. Do you think you will be able to time the market and get in at those lowest levels possible? No, not a chance. Don't fool yourself into thinking you can time the market. Traders, hedge fund managers, these are professionals and even they don't get it right. So what makes you think you, with no access to data, far less experience in these things, and probably a day job, can do any better? Simply put, you can't. So don't bother. Even these professionals struggle. So we shouldn't be trying to time the market unless that's an industry you want to go into as a day job. Then by all means, eat your heart out. Now I've got to warn you, I'm not a financial professional. I'm not qualified to give advice, but this is what I'm doing right now. I'm splitting my money up into chunks over 2 to 6 months, and I'm putting it in the market now. That way, I'm cost averaging my entry points, confident that some of it may hit the bottom of the market, some of it may not. But when the market eventually turns, I won't be kicking myself that I missed the bottom. I'm not worried about the day-to-day fluctuation of the market. I'm not stressing myself out, seeing my portfolio drop, worried to invest more, and then later I won't be regretting it when I missed those lows that I was worried about at the time. That way, you're not stressing yourself out. You're not fooling yourself into thinking you can time the bottom of the market just by watching one more YouTube video, by listening to one more expert on Bloomberg TV or CNBC, or reading another finance blog. That's not how I work. I don't want to stress myself out. I want to maintain a consistent, disciplined level of investment into the market, particularly at this time when I know the markets have crashed. To back all this up, I'm going to reference a JP Morgan study conducted a few years ago on the S&P 500 and the average rate of return that investors got over a 20-year period. They found that money invested in the S&P 500 returned on average 8.2% a year. Your money doubled once every 9 years. Now that's a pretty good rate of return, right? Now look what happens if you time the market. 20 years is about 7,300 days. If you try to time the market and just happen to miss the top 10 days in that 20-year period, i.e. 10 days out of 7,300 days, this is what happens. Your average return just dropped from 8.2% to 4.5%. Now, what do you reckon happens if you miss the top 20 days? Well, now your return is 2%. Still don't think that's a lot? Imagine you invested £100,000 of your money into the S&P 500 at the start of that 20-year period. An 8.2% return returns you $512,000. Missed the top 10 days? Your return is now 4.5%. In money terms, your 100K is now $245,000. If you had missed the top 20 days, remember just 20 out of 7,300, your return is now only $149,000. That's just $49,000 over 20 years. That kind of difference and impact is enough to make anyone reconsider trying to time the market. So what should you invest in? Well, again, I'm not here to give you specific advice on the investments you should choose, nor am I professionally qualified to do so, but I can tell you what I do. I no longer pick individual stocks and shares on the public markets. Much like trying to time the market, I've stopped kidding myself that I'm an excellent stock picker. I don't have a Bloomberg terminal on my desk or towers of monitors with different ticker symbols or the latest data to hand. So why would I think I would be a good stock picker? Could I make educated guesses based on the conditions in the market I'm seeing? Yes, probably. Am I likely to get it right more often than wrong? I'd like to think so. But here's the most important one. Have I worked out what my actual percentage return is when I have or was in a situation where I was picking individual stocks? Well, yes, I have. And what I found is I do not make, on average, an annual return greater than what I would have made had my money just been put into an index fund in the first place, which tracks the market for you at a very low cost. I have had those weeks and months where some of my picks have done spectacularly well, but over even a short 12-month period, on a percentage basis, they haven't beaten the market. When you're calculating this stuff, you've got to be dispassionate. and logical. As humans, we have a tendency to either block out the bad calls because they bring about the pain, the hurt feelings of the times that those bad calls happened. Therefore, we exaggerate the good calls, which, yes, might have been great, but we need to work out how often we've made them, how would they weigh up against how many bad calls you've made, and what has been your annual return. So what do? I invest my money in index funds. My favorites are the Vanguard US Equity Index and the Vanguard Emerging Markets Index. There are a couple of others, but that's a story for another day. The fees on these index funds are minimal, and Vanguard is known for keeping its fees as low as possible. So the eat into my actual returns is minuscule. And I'm not just looking at the expense ratio, the headline number, the expense ratio you'll see in all your brochures. That's not the number I'm talking about. That's only part of the picture. I'm actually loading up right now. I do think there will be further falls in the next 2 or 3 months, particularly as the market starts to report on the effects that this consumer dampening, the demand dampening that has happened since the lockdown began across the globe. There's undoubtedly going to be a massive rise in unemployment, as we've seen in the figures already. There's going to be foreclosures and repossessions across the board. The cash stimulus that many countries are putting in will help in the near term, but it's not going to stave off this crisis. Returning to any sense of normality is still a long way off, in my opinion. I think we're about to hit a major recessionary environment. Remember, this isn't a short-term game. You're looking to put this money into the market, let it work hard for you and bring you returns. We're not talking about day trading here. If you've got money set aside outside of your emergency fund, which you won't need in the next year, that's what you invest. Once you know you've got money available to invest, know that this could be one of the best times in the last 20 years to invest in the markets, and certainly in the last decade. And once you decide how you're going to go in, i.e. which index funds you're going to invest in, set a time frame, as I said earlier, put it in dribs and drabs, making the most of opportunities over the long term, and disregarding the daily turbulence and volatility of the stock markets. The trick is to invest consistently and avoid making rash decisions led by your emotions. With that said, thank you all for watching. I really appreciate it. If you found this video helpful, smash that like button. It really helps me out with the YouTube algorithm. Do that now. Thank you very much. And don't forget to subscribe to the channel using the big subscribe button below to get notified of when new videos are posted. See you next time.